everyone, and welcome back to the Everyday English Bite. In our last episode, we talked about how to grow our wealth through banks. But what happens when life throws a sudden, expensive problem at you? A car crash, a sudden illness, or a fire? One bad day can destroy years of savings. That is why today we are talking about the ultimate financial shield, insurance. We will explore how insurance is designed, why it relies heavily on math, the different types of coverage, and a very interesting comparison between the healthcare systems in the United States and South Korea. Let's prepare our minds with today's key vocabulary. Here are 3 essential words you must know when dealing with insurance. Number 1, premium. A premium is the amount of money you pay regularly, every month or year, to an insurance company to keep your policy active. Example 1, because I am a young, new driver, my car insurance premium is very high. Example 2, if you quit smoking and exercise, your life insurance premium might decrease. Number 2, deductible. A deductible is the amount of money you must pay out of your own pocket before the insurance company starts paying for the rest of the bill. Example 1, I had a minor car accident, but it cost less than my $500 deductible, so the insurance didn't pay anything. Example 2, choosing a plan with a higher deductible usually means you will pay a lower monthly premium. Number 3, coverage. Coverage refers to the specific risks, accidents, or medical treatments that the insurance company agrees to pay for in your contract. Example 1, my travel insurance coverage includes lost luggage and emergency medical care abroad. Example 2, you should always check if dental care is included in your healthcare coverage. Great, now let's dive into the complex but fascinating world of insurance. Decoding insurance. Why do we need insurance? The answer is simple. Life is unpredictable. We buy insurance to transfer the financial risk of a disaster from ourselves to a massive company. We pay a small, manageable amount today, the premium, so we don't go bankrupt tomorrow if a disaster happens. But how do insurance companies design these products without losing all their money? It all comes down to probability and the law of large numbers. Insurance companies hire brilliant mathematicians called actuaries. These actuaries calculate the exact probability of bad things happening. For example, they look at statistics and calculate that exactly 1 out of every 100 drivers will have a major crash this year. Because they know the probability, they can design the product. They collect small premiums from all 100 drivers. This creates a giant pool of money. Since 99 drivers won't crash, the company uses their collected money to pay for the one driver who does crash, and the company still keeps a profit. Without accurate probability calculations, the insurance company would go out of business immediately. Now let's look at the 4 major types of insurance products and their general coverage. First is health insurance. This covers the cost of seeing a doctor, buying prescription medicine, or staying in a hospital. Second is auto insurance. If you crash, this covers the repairs for your car, but more importantly, it covers the liability, meaning it pays for the medical bills of the other person if the crash was your fault. Third is property or homeowners insurance. This coverage protects your house and belongings against fire, theft, or natural disasters. Finally, life insurance. If you pass away unexpectedly, this insurance pays a large sum of money to your family so they can survive financially without your income. When we talk about health insurance, there is a massive difference between the United States and South Korea. It's a perfect example of 2 completely different philosophies. In South Korea, there is a national health insurance system run by the government. It's mandatory. Everyone pays a reasonable premium based on their income, and the government negotiates prices directly with hospitals. Because of this, medical care in Korea is incredibly accessible and affordable. To cover the small amounts the government doesn't pay, many Koreans buy a cheap private supplement plan called SILBI, actual expense insurance. The United States is completely different. Health insurance is mostly private and usually tied to your employer. If you lose your job, you often lose your insurance. the premiums are incredibly high, and the deductibles can be thousands of dollars. Because hospitals and private insurance companies operate for maximum profit, medical bills in the US are astronomical. In fact, getting sick in the US without good insurance is one of the leading causes of personal bankruptcy. While insurance is a necessary safety net, it has clear disadvantages. The biggest downside is the feeling of a sunk cost. You might pay thousands of dollars in premiums for 10 years, never get sick, never crash your car, and you never get that money back. It can feel like a waste. Another major disadvantage is the complexity of the contracts. Insurance policies are famous for having confusing rules and exceptions. Sometimes, when you really need the money, the insurance company might investigate your situation and deny your claim because of a tiny, specific rule in the contract. In conclusion, insurance is a necessary evil. It's a mathematical system designed to protect us from the worst days of our lives, even if we hate paying for it on our best days. Today's English idioms. We covered a lot of important concepts today. Let's wrap up with 3 common English idioms related to protection and contracts. I will explain the meaning and the context together, followed by 2 examples. Number 1, better safe than sorry. This idiom means it is wiser to be careful and prepared right now rather than acting carelessly and regretting it later when a disaster happens. Native speakers use this phrase all the time when deciding to buy extra travel insurance, bringing an umbrella on a cloudy day, or double-checking a locked door. Example 1, I decided to buy the extra travel insurance for our trip to Europe. It's better safe than sorry. Example 2, let's leave for the airport an hour early just in case there is traffic. Better safe than sorry. Number 2, read the fine print. Fine print refers to the very small text usually found at the bottom of legal contracts or advertisements. It almost always contains the hidden rules, restrictions, or disadvantages that the company doesn't want you to notice easily. We use this idiom as a warning to tell someone to check the details extremely carefully before signing anything, especially an insurance policy. Example 1, the insurance company refused to pay for my water damage because I didn't read the fine print. Example 2, the gym membership looks cheap, but read the fine print. You cannot cancel it for 2 years. Number 3, a safety net. Literally, a safety net is the large net used by circus performers to catch them if they fall off a tightrope. Metaphorically, we use it to describe a financial, emotional, or social system that protects you from total disaster. Savings accounts, family support, and insurance policies are all considered financial safety nets. Example 1, the government provides an unemployment safety net for workers who suddenly lose their job. Example 2, having health insurance acts as a crucial safety net for my family's financial future. And that is our 10-minute bite for today. You now understand the math behind insurance, the differences between global healthcare systems, and why we must always read the fine print. Review today's vocabulary and try to use better safe than sorry in a conversation this week. Thank you for listening to the Everyday English Bite, and I will see you in the next episode.